Okay, recording has started. And for today, it's going to be a general review. And if you have any questions along the way, feel free to unmute and ask a question. Or if you raise your hand, I probably won't see it. So best to either unmute, ask a question, or just type in a chat window, and I'll eventually see it in the chat window. All right, so the general disclaimer, anything we're doing today is purely for educational purposes. I'm not giving any specific trading advice. And what we're showing you today is how myself and my trading partner, who's Becky, she's the co-host, how we profit from the markets using options. This is how we go about profiting from the markets. And we've been doing it since 2005 now. So it's been a while. Time kind of goes by quickly. All right. These are the sectors which we trade with options. There are many ETFs that you can trade that represent different sectors, but those other ETFs may not have enough option volume and open interest to be tradable with options. This whole list is tradable with options, and you can get in and out of positions fairly well, some better than others. That's something you fine tune as you go along, what works for you best. But this is our list, and this is the only list we use for trading options on sectors. It gives a lot of diversity and things to choose from. Some people become specialists in certain sectors. Some people try to trade everything, and other people just trade whatever certain subset, a grouping of sectors. So I've been evolving over time. Now I just trade certain things because I just want a limited number of trades each month because it works really well for me. And I'll show you some of that this afternoon also, and some of the things which I trade. All right, first, let's take a look at a big picture of what's been happening in the market. And I will switch the view to the chart. Okay. What you're seeing right now is a monthly chart of the Dow. So every candle is 1 month. Okay, big picture view, 1 month chart. This is going all the way back to 1999 and 2000. Okay, this blue line is a 40 period simple moving average. You're going to find a 40 period simple moving average on almost all of our charts in some way. We use them on monthly time frames, weekly, daily time frames, intraday time frames. A 40 is always on there. How we started using the 40 had to do with Oliver Velez. He is one of the gentlemen who was one of the people who we learned from along the way. And he always had a 40 on his charts, and he used that to determine trend or line in the sand above or below which it was either bullish or bearish, that type of thing. And we started doing it, and it became a standard part of our charts also for those same reasons. We use it to indicate trend, and so it's become a great tool in all of our charts, the 40 period simple moving average. That's why you'll see it on our charts. This is a monthly chart of the Dow. So here we have an uptrending 40 period moving average, and then we close below it monthly. And then we close right back above it. Pretty normal. You'll see periodic pullbacks to the 40. Now, if you see two big closes below the 40, it's more likely than not that the market is going to be going lower. So that's something learned from some other people who I traded with or learned from. All right, so this was the debacle back in 2001 where the market crashed, okay? So this was the drop in 2001. The market just went down, wiped out a whole lot of tech companies in that time. That bubble burst, and we're below the 40. And then this is in 2003 markets. Once again, each one is 1 month of time, 1 month. We close above the 40. And since then, we've basically been in a massive uptrend, except for small periods of time when we went below and then right back above. But right now, 2003, we were above the 40. And then we periodically, every couple of months, we will have a pullback to the uptrending 40. this is what I look for buying opportunities. Every time we see a pullback to the 40, our daily chart strategies, hang on a second. For anyone new coming in, I was going to put the link in for the handouts. Got a question from John. Did you say 40 SMA? Your chart says 40 EMA. Do I have 40 EMA on this chart? Okay, this particular one is EMA, but it can be SMA also. But I usually do SMA, but EMA works just fine also. It won't be that big a difference on the monthly. On a daily chart, it makes a difference. On the monthly chart, not as big a difference. All right. So we do a pullback to the 40. So whenever I see the market pulling back to the 40, we get our trade signals off the daily charts. So let's say it is this month here, which is August in 2004 or October 2004. If I see the market pulling back on the big picture towards the uptrending 40 SMA or EMA, then I will be looking on my daily chart strategies for buy signals anywhere in this area. Anywhere in this area, I start seeing buy signals on my daily chart strategies, I'm going to get long, because that's going to be telling me that I'm going to get a nice bounce off of these levels. So whenever I see a pullback here, I do not get shy about getting long when I get a buy signal on our trading strategies. All right. And we'll go through one of those strategies this afternoon. Every couple of months, we see a pullback, uptrending 40, then we get a massive rally. And here we are in 2007 and 2008. Okay. We got this big pullback, and then you buy, goes up. Nice trade. Think about it on a daily. This is a monthly chart. Daily charts, you're making money. Then came 2008 when we got multiple closes below. The two closes below. Then came this drop in 2008 when the market just got crushed. Okay. Now, that doesn't mean our trading is bad. It just means we have short signals, and you're going to have longs in there too. That's why we trade long and short. We're not investors. We are traders. It doesn't matter if the markets are going up or if the markets are going down. If the markets are going up, we take our long trades. If the markets are giving us sell signals, we take our short trades. That's why, from my point of view, you are not a complete trader until you can trade both long and short. I've met a lot of people who, from a mindset point of view, have a lot of trouble taking short trades. I've met a lot of people who have in their mind, an ethical reason to short markets. They don't think it's ethically right to short markets. They can only go long. And so from a trading point of view, they will not do as well as other people who can trade long or short. So if you want to be a well-rounded trader, you got to be able to go long and go short. So when the market's getting crushed, you need to be making money all the way here, or else you're going to be among all those many investors out there who just sat and watched half of their life savings melt away when the market literally dropped 50% between 2007 and the first part of 2009. The S&P dropped 50%. Okay, markets dropped 50%, and people's 401ks melted away. Many companies ceased to exist. Big S&P companies, big Dow companies, big NASDAQ companies went out of business during this collapse. Banks went out of business, big banks. That's why, from an individual trading point of view, we need to be able to capitalize on these market moves also, not just sit there and hope for the best, hope for the market to go up. So that's the benefit of being a trader. We get to be able to capitalize on these moves also. So this is in 2009, and after several months, we are back up above the 40. Every couple of months, once again, we pull back to the 40, buying opportunity when we pull back. Rally. Buying opportunity after it pulls back. During these pullbacks, you're going to hear on television, on social media, on those cable channels, news channels, the markets are going to go down forever. Um, you know, and the sky is falling, and they'll literally claim doom and gloom and everything else. From our point of view as traders, we look forward to these opportunities to, number one, capitalize on the markets pulling back, and then as they pull back, look for the buying opportunities along the way. I always look for the buying opportunities right in this area. When anywhere around here, around the 40, I'm looking for my buy signals on my daily charts. And those are the ones that are going to be the most profitable. So this was 2011, markets rally. And there've been this massive uptrend's been going on for years now. Pullback, this is 2015, markets pulled back to the 40. Look for your buying opportunities. Now they're buying opportunities all through here on the daily charts, but these are, if you're an investor, here is where you want to be buying as an investor, somewhere in this area. If you're a longer term investor, these are the perfect opportunities. Pull back to a massive uptrend to long-term support. You should be salivating, waiting for this, right? Well, on daily charts, cha-ching. And this happened a couple of times over a couple of months, pull back, buying opportunity, pull back, buying opportunity. Once again, massive rally. This was 2018, pullback. As soon as you see the markets pulling back anywhere in this area, look for your first buy signals on the daily charts, cha-ching. These are the absolute best trades. And you're going to find a lot of these happen in the October type of time frame. This was COVID time, beginning of 2020. This is when the sky was falling, massive gaps. This was some of our most profitable trades that year. With these gaps, our short trades were hitting 60, 70, 80% doubling in value with massive gaps each day. This is when we capitalized on it to a point where we ran out of things to trade because we were exhausted. We had traded everything we could possibly trade short. We were just waiting for the next set of buy signals, basically. It only closed below for 1 month and rallied right back up, one of the biggest rallies in market history. This is COVID. It just goes back to support, right back up. Rally, rally, rally. Here we are in 2022. Markets pull back to support. And if you take a look at any of the last couple of meetups we did, I'm telling everyone all the time, here are my buy points. I'm going to pull back to support. Anywhere in this area, I'm buying. I'm looking for my buy signals. Okay. Pull back to support area. Anywhere around here, I'm looking for my buy signals on the daily charts. Last couple of months, when I was doing meetup almost every month, I was telling people I'm looking for pullbacks anywhere to this area, and here's where I set up my longs. I might have had a valid long trade somewhere here, but I waited to get into it down here. I waited for these buy signals down here because I know I'm going to have the biggest, best rallies from these levels. And also from a seasonal point of view, there is a certain October, November type seasonal long, which we'll go over in a little bit, that I'll try to capitalize on. So there's certain timing to get the most out of my money from these type of trades. Okay. So here's where we are right now. And we've been basically making money on the long side. Now we've been seeing sell signals. So that's the big picture. And now we're getting sell signals when we're up here. This is December, this is January. So we got our first sell signals at the end of December. And we'll take a look at that momentarily. Okay, that's the big picture. And I'm going to switch back to the handout. Share this. If you have any questions, feel free to once again unmute, ask a question, or type it into the chat window in the Zoom application. Go back to the handout. Let's see. Okay. I should be back on the handout now. So once again, here are the sectors. And this is a weekly composite chart. This is from Jake Bernstein, Seasonal Trader. Good place to go to if you want to get seasonal charts, seasonaltrader.com. The information is right there. This is every year I tell people the most profitable time for our trading is like the October through the end of the year, and then right through April, also very predictable patterns. This is a composite chart of about 37 to 38 years worth of time, all put onto one chart. And it shows a very definitive bias to the upside from October through December. Okay. This is a pattern we trade every year, myself and Becky and anyone else I'm working with. And we look for buy signals anywhere in this time period. Okay. We look for buy signals because if we get a buy signals during this time period, factoring in history, seasonality as an additional confirmation, we tend to get our best, biggest moves. This year was even better because not only did we get the seasonal pattern, but we also have the massive uptrend, and we had a picture perfect pullback in the markets to that long-term support level. So right here in October, November, we got the pullback to support with an uptrending 40. We got a pullback to support, and it tied in beautifully with the seasonal pattern. So it's just been picture perfect as expected. Okay. Now, literally the last week of December, we got a bunch of sell signals in several markets, probably 8 to 10 different markets. We got sell signals this last week of December. Seasonally, historically, over 30 something years, these first couple of weeks, end of December through the second week of January, the markets go sideways and then bearish, sideways to bearish. I took my first sell signals during this last week of December, and they've already been hitting targets this week. And we're still not done with that expected bearish path cycle. So I had sell signals coming in along the way, but I passed on those because I have a better chance of those being successful trades, or at least not going against me for a while, not tying up the capital, if I can time my sell signals with also seasonal patterns. So I took my sell signal, I might have gotten them here or here or here, but I took them here. Okay. And those have been hitting first targets. I'm going to switch over to the daily charts, and I'm looking for, like, just to continue this in January. In the 3rd to 4th week of January, the market tends to dip for a little bit, or a lot sometimes. We can't really quantify how big this dip is. It just tends to dip like it has been doing like recently. And then from the end of January through the first part of February, we tend to be bullish. So if I see buy signals coming in the 3rd, 4th week of January, I'll be looking to make sure I get into those long trades because they tend to be enhanced with the seasonality as an extra confirmation. So I might get a buy signal here. However, I would prefer to hold on taking or getting long until I see buy signals happening after a pullback, and looking to take my buy signals in week 3 or 4. That's when, because there are a lot of potential trades, but I try to not tie up my capital longer than I have to. So this trade I take here long might end up being a good trade, but it might get tied up for 4 to 8 weeks. Whereas a trade I take here that's long I might hit my target within 1 week and be able to lock in profit. So neither way is wrong. It's just that as you get more efficient and utilize more of the tools, understand the bigger picture of the markets and what to expect, it's easier to time when to actually trade and when to say I'm going to pass. because as time goes on, as you've been trading longer and longer, we want to take fewer but more quality trades than going for quantity of trades. When we all want to take every trade, want to trade in everything, want to be in everything, we want to be in that. But as time goes on, you don't want to be trying to trade more. You want to try to trade less, take bigger trades, take quality trades, do less work and make more money. Not do more work and make a little bit of money. You want to do less work and make more money. And that's what I call this, understanding the bigger picture of the markets. We still have all of our trade signals that work beautifully, 80-something% wins, still works, but we can make more money and do less work. Like one of my trades here would be the equivalent of 3 to 4 individual trades at certain other times because of the profitability, just by understanding when to get in as opposed to just getting in. And I'll show you an example of that in a little bit also. But this is a big picture view of how we trade and some of the thought process in deciding which trades to take and when. Even though trade signals might say the trade's valid today, maybe tomorrow isn't the best day to place to trade, but it all depends on personality and your own personal schedule. Maybe you just need to get a trade done and taken care of, great. But the more patient you are, the more you wait and relax, the more you can actually catch some really big, nice trades. Okay, so once again, any questions, just unmute and ask me, or go ahead and type it in the chat window. I will be needing someone to have a calculator, so please, someone pull up a calculator. So I'll be asking you some questions which require a number. So get a calculator ready. And I'm going to switch to the daily chart now. We're going to look at actually, let's go scroll down here first. The strategy some of you have seen before. Donchian cross buy. This is one of our first signals we get long. And if you take a look at the chart on this handout, this orange line is a Donchian main line from Donchian indicator. And the blue line is the 40-period moving average. And what we're looking for is the orange line to cross over the blue line. That's our setup. Setup trigger trade management is terminology borrowed from Jake Bernstein. Learned a lot from Jake Bernstein. Met him in 2009 when he first came to California, and he opened up his whole world of trading to us and taught us a lot. And what we got, myself and Becky really got from him, was how to maximize profits, and we adapted some of his knowledge to what we do, to enhance what we do. All right. And I just took over his meetup group also. It was about to cease to exist. So I just took his Great Bay Investors, his meetup group. So I just took that group over. So if you're in that also, you might see some of my meeting notices posted there also. So I just took that over because it was about to cease to exist. So I went ahead and kept it alive. All right. So setup trigger trade management. Orange line crosses blue line. That's a setup. And there's some other criteria with the Bollinger Bands and the number of days in a bearish cross that I go through with people during coaching sessions. There's more detail. But once I have a valid setup and trigger, I know that I know I'm going to have over 84% wins, because that goes back to the full history of the ETF. Whenever this situation happens, I know that the markets will move at least one ATR in my direction, average true range. That's means the volatility of the underlying ETF. That day it might move one ETF in my direction, in this case upward, sometime within the next 1 to 2 months. That's all I need to know. And that happens 84% of the time. I get this crossover, the market will move at least one ATR in my direction within the next 1 to 2 months. It's not just my job to know how to best capitalize on that with options. And in this particular case, in all of our strategies, we just buy calls and puts. I've had people who are really, really, really fantastic spread traders take a look at all these strategies and tell me if they can find a spread trade that can give me better results than just buying calls or puts, and they've all told me no. This strategy is for buying calls, just straight up calls, not spreads. There are times and places to put on spreads. This is not one of them. Just buy calls outright and don't limit how much you can make. You also, you do not limit how much you can make. And that's really important. All right. Here's some of we're going to take a look at IWM on a daily chart, but just to give you some history first. This is IWM, this is Russell 2000. And this is the history of this particular strategy on Russell. It is 98% wins with a 1 ATR profit target. That goes back to 2001. Basically, one loss? This is how I trade, this is how Becky trades. We need the stats, we don't just guess. There are a lot of things in the market that repeats. And once we find something that works for us, we just keep capitalizing on it over and over and over again. This is one of them. This Donchian setup on IWM. We have 28 ETFs. This works extremely well on IWM. We might get a couple of trades a year. Whenever it comes up, we take the trade because it works extremely, extremely well. Going back to 2001, when it's valid, take the trade. So now I'm going to switch over to the chart so you get a good feel for this right now. We have a second example in here also for XLB. That one's only 93% wins. Okay, same type of thing. All right, so now this is options. You're buying calls and puts, and I know a lot of people, they buy calls and puts and they're like, well, my call is time decay and all that type of stuff, and I'm going to buy it. It's going to go. Well, there are rules to buying the calls and puts, and depending on what you buy it on, yeah, you might have issues with time decay and that type of thing, but that's more applicable to stocks than ETFs. ETFs don't have the same implied volatility issues that stocks have. That's what lets us be able to just buy calls and puts on ETFs and not have to worry about volatility crush and things like that. So let's say realistically 93 to 95% of our trades with options which hit the first target are actually worth more than what we paid for the option. Some trades will have time decay issues and you might come out with a slight loss. That happens. But realistically, this works extremely, extremely well. And there are ways to double to triple your very baseline profits. There's a minimum returns by doing a minimum amount of work, but if you are a little more patient, sometimes getting a better price than expected, where you might be thinking to get 20 something percent return, all of a sudden you get 40, 50, 60, 70% return at just the first target, and the trade's not even over yet. So we're going to take a look at IWM as an example. So here are the trades, the trade dates that were valid, and I'm going to switch to the chart of IWM. And I'm going to share that officially, so make sure it's coming through okay. IWM and share. Okay. So now you're seeing the chart of IWM, and that's Russell 2000. Let's take a look at this last trade we had valid. That was on 11/15. Here is where the orange line crossed the blue line. I'll let you know all the other criteria was valid, and we already know it's 98% wins when this situation happens. When this orange line crosses the blue line and the other criteria is valid in the trigger. So visually, what we look for is a setup. Reviewing a list of 28 ETFs goes really fast. If you're doing it manually, you can write a program for it, but it's simple. On this date, did the orange line cross the blue line? No. Next day, did the orange line cross the blue line? No. Orange line cross the blue line? No. Did the orange line cross the blue line? No. Did the orange line cross the blue line? Yes. That's it. We just did our review. Each day you do that, click, click, click. You go through each ETF, did the orange line cross the blue line? Nope, yes. So all we look for in our setups is, the setup is very visual. We're just looking for two lines crossing or change in color for a different indicator, for a different strategy. That's all it is, two lines crossing. It's simple because we made it simple. We've taken a whole lot of technical analysis, and we've taken literally years worth of work and analysis and effort and compiled it into strategies that look simple, but they're not. You have to understand that to come up with this took a lot of time, work, and effort. And there's a lot of different knowledge that's compiled into my brain and Becky's brain that allow us to get to this point now, to be able to make it look this simple, to find these two lines that, and then have the trade management to go with it. That took hundreds and hundreds and hundreds of trades to work out the detail, and I've literally put in probably 25,000 hours of analysis time, and I still do it every week. I'm always looking, how can we make things better, faster, more efficient? How can we, right now, in the last week, I've had Becky looking at how can we enhance the current ETF option strategies to add even more trades to a certain subset of those ETFs, because the last two meetups I did, we focused on the Dow, S&P, and NASDAQ, and some people had more interest on that. So just trading those three. So we're looking to enhance those three and add even more trades just for the major indices. So stay tuned for that. And futures is, we're always enhancing futures. Futures are just great for us. We're looking at 40 to 60 something % return on account on futures. And that was at a low end for last year. So futures are just great. Those are the best, easiest to trade, least amount of work, least amount of risk. Is just put in your target stop, entry, target stop, walk away. So futures is our bread and butter. That's our foundation. So those are just beautiful for us. So if you want to talk about futures, let me know. We're gonna have a futures meetup in 2 weeks, and if you want more, you can always call me or message me. But our future strategy is extremely, extremely, extremely efficient and work for us nicely. All right, so we got our crossover. Okay. If you take a look at the data box, we have our open price, high, low, close, and an ATR. So here's where I need a calculator. ATR is $4.18. I'm just going to type it in the data box, 4.18, excuse me, 4.18 ATR. Okay, that's the ATR for this day. It's $4.18. That is the average true range. That is a measure of the volatility of the underlying ETF. We do not do analysis on options. That is a completely different type of trading. This is a whole lot simpler. We do the analysis on the underlying ETF, and we use options as a way to profit from the movement of the ETF. But all the analysis is done on the ETF itself. And we trade the first in the money option that's either 1 to 2 months out, depending on the stats. So when we provide the stats for 1 month out or 2 months out, and usually you don't want to go more than 3 in most cases, but some people go way further out because it's a choice, and also situations allow us for bigger targets, so it compensates for higher priced options. So there's a lot of variables that we deal with during one-on-one coaching sessions, because everything's tradable. All right. So the next day we have to enter the trade at or below the open price of the ETF. So the next day the ETF opened at 178.14. I'm going to type that in. 178.14 open the next day. Our first profit objective will be the open price the next day plus the ATR. What is that value? Where's the open price the next day plus the ATR? What's the open price the next day plus the ATR? Someone type it in. Thank you, Olga. 182.32. Okay. So let's say we get in our trade right at the open. Right at the open, it opened at 178. So we're going to get a first in the money option, 178 call options, and it's going to be 2 months out. So we're looking at January options. Okay. And the next day, the market went as high as 178.64. The next day, it went as high as 179.65. So our first target is not reached yet. The next day, it pulled back. Next day, it went as high as 179.39. Didn't go to target yet. Not yet. Not yet. This day, it went as high as 181.75. So target's not reached yet. Not reached. Here, this day, the target is reached. It hit during this day, 182.32 was reached during this day. So the way we would have set our trade up, we buy our in the money. I say we're doing it right at the open. We buy our first in the money option for January. We now have the call option sitting in our account. If you do the least amount of work would involve an exit order saying, sell to close my contracts of IWM when IWM ETF is at or above 182.32. And then go about your life. There's nothing else for you to do. Go live your life. You got up the next day, you got in the option, you put your $4.18 target in after your order was filled, and you wake up sometime during this day, you get a message, text or email saying your order executed, and now you have money in your account from the sale of the option. Done. Okay. Let's say you didn't get in right at the open because you don't want to get up 6:30 in the morning Pacific time because you like to sleep. By the time you got up, the market had dropped from 178.14 at the open and is now trading at 176.14. It dropped 2 points from the open. Let's say it went from 178 down to 1. By the time you get to the market, turn your computer on, everything, the market's down here. Even better, your entry is at or below the open. Let's say that it was at 176.14 when you got to it. Then you buy the first in the money option. You buy the January 176 strike call option. Now, instead of having a $4.18 first target, now you can have, if you choose, a $6.18 target. That would put you, when you hit this first target from this entry, from the original entry, you're going to be 4 points in the money. If you get in at the even lower price, you're going to be 6 points in the money. Okay? That's an extra dollar something, $1.30, $1.40 worth of, at least $1.40 something, at least with a couple of extra deltas worth of profit in the option, because you're going to be doing 70, 80 delta options by the time it reaches here. When you buy the option, it's going to be about a 55 delta. And by the time you've gone in several strikes, you're up to 70 something, maybe 80 delta option. Your profits start magnifying quickly. Where you would have maybe gotten a 10 to 20 something percent return by buying your option right at the open here, getting in close, getting lower, now you're into that 40, 50, 60 something percent return on your money on the option price. Okay. That's how profits can magnify quickly because 10 people placing the same trade can get 10 different sets of results, depending on all different variables, just as simple as which day you got into it. You could get into the trade this day, right? The open. Some people might get in all the way down here and have like a 7-point target. Some people might get in the next day because we were below the open, below this. The entry is 178.14. As long as you're below 178.14 and the first target's not reached, this trade's in play. You get into this trade this day, 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 this day. And this would have been the last day that you could enter the trade at or below the open price of 178.14. So you had 7 to 8 days to get, we got 1, 2, 3, 4, 5, 6. You had 8 potential days to enter this trade. That's why people who are more patient get better opportunities. Like, let's say you, for whatever reason, you were traveling, whatever it might be, you were work, you had family things to take care of, you just plain old missed the trade. Now, taking this as a great example here, you didn't miss the trade, you missed the trade, you were doing whatever, you were traveling with the family, you went for Thanksgiving vacation, and you came back and you take a look right after you got back from Thanksgiving and you say, hey, there was a trade valid back here. It hasn't moved yet, but now you're going to buy the exact same option that you would have back here, but it's going to be 7 days cheaper. Okay, you're getting a much cheaper option now because a week has gone by. You buy the exact same 178 strike from January, but now you're buying the 178 strike from January, but it's this much cheaper because that much more time has gone by and this time decay each day. So you're actually buying the same option, but buying it cheaper, and then cha-ching. Fast move. And remember, trades don't have to end here. If the market keeps going up, you can trail, if you can sell part of your position automatically at the first target and then put a trailing stop on to capitalize on the remaining options, remaining contracts. And I go over that with people because there are different ways to do that effectively, efficiently. Okay. So this is what I'm going to be, this is one of the strategies I'm going to be looking for as the markets pull back, along with any of the other buy signals which are going to be happening. So we got this, we're seeing this pullback happening right now. So between this strategy and our other buy signals, we're looking for, like we had our sell signals all the way up here, and I said it happened at the end of December. This was end of December. We had multiple sell signals. Let's pull up S&P or the Dow. Let's take a look. Here's the Dow. Should be similar. Not as deep a pullback, end of December. So we got our sell signals and we pull back. I'm actually short Dow right now. We had a couple of targets get hit already, but we have more targets. So I'm actually short Dow. Take a look at S&P or NASDAQ. The NASDAQ pullback, there were multiple sell signals in the NASDAQ at the end of December. That's already pulled back quite a bit. Multiple targets already have been hit with the NASDAQ. All right, and its gaps are sweet when it comes to options and out on a short side. So we had multiple. You don't see, this is not a full chart where you see everything. We say that for the coaching clients, but we did have our sell signals all this last week of December, just like you saw on that big seasonal chart. It all happened literally the last couple of days of the trading year, and that's where I got short for the markets. And I've been capitalizing on this move down. So we had several targets already hit, and I'm still looking for a couple more. Another one I'm in right now also, because we had several trades kind of stacked up. XRT, retail. A nice end of year run up. I am in XRT right now, short. And this was one target getting hit. And then I'm still in, I got in up here somewhere. One target was hit here, and I'm holding additional options contracts for a lower target. All right. Now, some of these sell signals were valid like here. One of these sell short signals was valid here. Another one was valid right here. I did not take the trade here. I did not take the trade here. I took the trade up here because that big seasonal chart, which I showed that through December, it rallies, and then starting that last week, that end of December, that last week of December, is when we see the market go flat and bearish. So I did not take this trade or this trade until this week, until it was all the way up here. Then I bought my put options. Up until here, I was trading long. I bought my puts up here because of that seasonal chart.
Question, Everly?
Yep.
You mentioned before that in the example you gave where you get a trigger and you, for whatever reason, you didn't take it right away, you got up late, whatever.
Yeah.
How do you, or what criteria, if you use any, to determine, okay, I'm going to take this trade. I know that it's later, but and I've got a greater ATR added because of the added distance.
Yeah.
What happens, or if it goes the opposite direction? In other words, you didn't get it at the open and it opened up, and it opened the opposite direction. In other words, you don't have the 4 point whatever direction of ATR, but only 2.18. And we know that it vacillates. The market volatility happens, and so you may want to wait for it to come back down to your entry point.
Okay, you want to use this as an example?
Yeah, go ahead. You can do put or call, doesn't matter.
Okay, let's say I got my sell signal right here. Okay, and this was a sell signal. Okay. Per plan, the entry is the open price at or above this entry, this open, right?
Correct.
So what you're asking is, okay, now clarify your question now. What?
Well, in this example, you're looking for a put or the market to go.
So this is what I'm looking for, put, yes.
Okay, and it moved up higher on you.
It moved up higher.
So we got a better price for that put. I mean, a better opening position for that put.
We got a better entry. We now have a potentially bigger target, yes.
Correct. But if it had gone, say you didn't get in at the top at 73 put, but you waited and you weren't able to get in till it was back down at 70, would you still take the 70, or would you wait to see if that market comes back up again to the 70?
Well, the entry for this trade is at or above 71.87, so it'll be the 72 put.
Okay.
So no matter what, you have to enter this trade at or above 71.87.
Okay.
Once the target is hit, the trade's over.
Correct.
You might have missed it. If you missed it, too bad. But if it came down, like here, it came lower, right?
Yeah.
But you can't take a trade because it's below the entry. It has to go back above this open price. Once it goes back above the open, it's tradable.
Okay.
Here it came down and it was below the entry price. But once it goes back above, the first target wasn't reached yet, so it's still tradable. So even here, even 1, 2, 3, 4, 5, 6, 7, 8 days later, we could have still taken this trade with put options because we had our sell signal here. We could have taken this trade this day once it's above, this day, this day, this day, this day, or this day.
Sure.
Here it's too late because here it's already below the entry and the target is getting hit within a day or two. So anywhere above here is fine.
And it may be beyond the scope that you want to discuss at this point. But if you had taken it a day or two later when the market is rising,
perfect, because your puts are cheaper now too.
But there's nothing to say that the market couldn't keep going higher.
That's correct. this is a call you make. As I say, a business decision. You already know that what is this, about 84 to 86% wins, if I recall correctly.
Okay,
Well, when it doesn't matter whether it's you're getting in, it's good if the trade is valid as of this point.
okay,
Anything above or getting in higher is what I would call icing on the cake,
sure.
because any higher entry price will give you that much bigger a target, which will negate any potential time decay. So it's actually perfect, because a better entry price will negate the time decay. And historically, when we get these gaps, this volatility will juice up those options even more for us. So I'm really hoping for another gap on Monday or Tuesday morning.
Sure.
I still have more options in this trade. So I want to see another gap down and a pullback all the way down to this support level at the uptrending 40. That's what I want to see.
Yeah.
I can capitalize on this. And remember, if you see this pullback here, remember that seasonal chart right about here in the third week of January is where we start seeing another little rally going into February. So
Okay.
with looking for new buy signals over here, which might be the T lines, because we're already in a trend. We may not get a Donchian here, but we might get a T line buy. But I'm going to capitalize on this short as much as I can. I'm going to milk this while in this uptrend. Talk is getting hit. I want to try to milk this as much as I can, because we don't know what's going to stop here. Well, once you're in it and profits locked in, I'm hoping this keeps dropping a ways. But we don't know. But once we lock in profit, the rest is just, let's hope it keeps dropping a little bit more and lock in some more profit.
Thank you.
All right, Ken. Oh yeah, and by the way, Ken, I'm good for next week, Sunday afternoon.
Okay.
We'll see
Thank
what's
you.
up time, maybe about 2 o'clock-ish.
Okay.
I'm kind of a little old school. Whenever people want to meet in person, I prefer to meet in person whenever possible. Ken likes to meet in person too. So we're gonna meet next week, Sunday afternoon, and go over some stuff. All right. Okay, up to this point, do we have any questions on anything whatsoever? Some of you have seen this before. Some of you are trading the strategies. Some of you are brand new to it. Feel free to unmute, ask a question, or type it in the chat window. And I will be sending out a video of this later on. All right, so I'm gonna go back to, yep.
So this is Linda. How long where are you getting your signal to how long you buy that put for? Is it for, are you able to tell what you're buying it for a month, for 2 months, or?
Okay, everything we do is based on what I'll call expiration cycles.
Mhm.
Let's take a date here, 6/22. 6/22/23. Okay, Linda, when is expiration Friday in June 23? What date? Pull up your calendar. And you're gonna tell me how much time. What
right.
is expiration Friday? Only the third Friday only is the only expiration Fridays we use, the third Friday only. So what's the third Friday in June 23?
Third.
Is what date?
The 23rd.
Is the 23rd the third Friday?
Oh, I'm sorry, 16th.
Okay. So once we get past the 16th, we need these stats. I'm going to go switch quickly back to the chart, to the handout, and then we come back to this. These stats are based on 2 expiration cycles, okay?
Mhm.
And we also give you stats for 1 expiration cycle. So if you want less time, you pay less for the option, but the win-loss percentage, instead of being 98%, might be 93%. Because less time, you might have more losses. More time, less losses, but you pay more upfront for the option. So smaller percent return. So you got trade-offs, you make decisions. But all these stats are based on this is basically 2 full months of time. And now I'm going to go back to the chart and show you what that means here. Okay. You said the 16th was expiration Friday in June.
Correct.
What's expiration Friday in July? What date?
It is the 21st.
Okay. So July 21st expiration Friday.
Yeah.
If we need 2 full cycles of time, since already started, one cycle ended on June 16th, okay? The next one started on minor daily 16th. On June 19th, 14, 15, 16. So the next cycle started on June 19th. Okay.
Mhm.
This trade became valid on 6/22. From June 19th to July 21st is one cycle.
Yeah, a lot happened.
But that is, we need 2 full cycles. If we are starting after this cycle has already begun, July would not count as one full cycle because we're already in that cycle when this trade became valid. So we need 2 full cycles. That would be July to August and August to September. That would be 2 full cycles worth of time.
Okay.
So we'd be looking for the September option. You also will have stats for the one expiration cycle. So if, like I said, June to July will not count as one cycle because we're already in it. And we require 1 complete or 2 complete cycles, not parts. So that is how, over time, we've established how much time to put into an option. It is basically 1 to 3 months worth of time.
Got it.
Now, some people go out 4 months, 5 months to find options. They pay a whole bunch of money, and they're okay tying up capital for smaller returns. But you can get those more returns by getting in a better price to overcome the higher price of the option. So they're trade-offs. You can overcome the higher option prices. But I prefer to keep it in the less than 3 months or less type time frame, because once you start going more than that, the option pricing becomes really expensive. And is it worth tying up all your capital, so much capital, to get a 1 or 2% return because you spend so much for the option? See what I
Right.
mean?
Yeah,
So
right.
I would rather pay a little bit less for the option, or and get a much bigger return on my money than tie up capital for getting a small return, because you don't know how much you're going to make on an option trade. You literally don't know. So this is you try to make smart decisions, as at least as smart as possible given the information you have.
Exactly.
But that's kind of what we do for time-wise. So this, I'll be looking at a September option if I'm doing 2 cycles, and I'm looking at a August option for, because there'll be 1 complete cycle for 1 cycle, and the target's going to get hit within a couple of days. So it's a quick move, targets hit. Yes, you have this much more time in the option, but what that allows us to do is trail stops. You can get an August option, which is, or September option, but you won't, but you could potentially stay in it for another several weeks by selling, let's say let's say you have 3 contracts. You sell 2 of the 3 contracts at the first target and trail the stop with a remaining contract for a little while. See what I mean?
Yeah.
So that's how we kind of just maximize profits on remaining contracts. So, but some people like just get all in, all out. They don't want to deal with managing positions. I am an all in, all out guy at certain times of year, except for October through December. October through December, I position myself for that big rally. So I will not exit a whole position. I will exit part of a position, hoping to get a continued move in the option. Because there's certain times of year when we just catch some really sweet big moves and different markets. So I'm always ready for those. But certain times I just like, I don't want to deal with it. here's my, I'm in with 5 contracts, I'm out with 5 contracts, I'm in with 7, out with 7 contracts, don't want to deal with any trade management. Just let me grab my money and go, next trade. It all depends on you, your time, personality, so on and so forth, record keeping. I'm not into the record keeping thing. Becky is the one who puts all the numbers in boxes, all the spreadsheets. She does all this stuff. I like to trade and do the analysis, and she keeps all the records and all the history.
So is that what you guys help with then? Is this was new to me, the ATR
Okay,
and all of that. So you did that example on the other one. It wasn't on this one, right? It
it
wasn't
wasn't
the
on this particular trade, but
So
I'm going to IWM.
that's okay. This one's great. Is that where you guys help out by doing all the analysis and then helping us learn how to trade within that range?
You got it. So each evening I email out Becky, and on afternoons I do the review of all the futures trades, and I send that out to all my futures coaching clients. And in the evening, Becky does a review of all the valid option trades that day, sends those to me, and then I email those out to the ETF and option coaching clients. I expect you to do your own work also. And basically, like, I know Ken, you just heard talk a little, I know he does his work every day and then waits to get the results from us to confirm that what we did matches what he did, what he found. And that's the ideal way of doing it. That's really the ideal way of doing it. I see Ken in the waiting room. Is that the Ken? Did he get bumped out or something? Becky, that Ken in the waiting room there?
Yeah, that's me.
Okay. All right, so, but yeah, that's what we do. We just do the same analysis. So Becky will go through all of these, all of the ETFs, find every trade that's valid for the day. That's 84% wins or higher. So only trades we send out are the ones that are 84% wins or higher. And we send it out each day, each evening. Now, whether you got into the trade the next day is up to you. But certain ones, if you wait, you miss it. Like this one, as an example, if you waited a day, you missed the trade. Yeah, the next day, great. So when people are starting out, they always try to get in right away. Perfect. But as time goes on, you tend to realize, you can make more money if you wait, because quite often the trades will kind of pull back. Here's an example. You got your trade valid this day, but then it pulls back for 2 days later and then takes off. Here's an example. Trades valid this day. Here is the entry price is down here. The open is always going to get hit within 1 day. You miss it that first couple of hours that morning, you're going to miss the trade. So every trades might be a little bit different, but the same basic concept. Here's the crossover day. Get in the next day. The trade target might be hit the same day, because you get in here, it shoots up, hits the target. Some trades move quickly, some are slowly. Crossover,
Where do you
boom,
show
hit.
the target over here on this one?
The previous one?
No, on this one, the XTR right here, you
This one?
correct.
Okay, let's see. You can't always tell by looking with your eyes when the orange line crosses the blue. So you have to use the data box to, here's the orange mean line. This is NinjaTrade I'm using here. You can also use Thinkorswim platform to do the same analysis. So right here, the orange line is 92.77, 92. So the orange line is below the blue line. On this day, the orange line is still below the blue line, 92.95, 92.96. So on this day, it did not cross yet. On this day, the orange line is now above the blue line. Okay.
Got it.
So here is our valid trade day. That is 11/2. You can see the next day it opened and shot up. If you waited, you're going to miss the trade.
Yeah.
There's a little tiny wick here. So you didn't have, so this was one of those trades where if you're at the open and you got your trade on, you're gonna hit the first target on day one. The target would have been $1.82, and that got hit well within probably the first part of the day after the market opened.
Oh, I see. And then your high, you say when to get out to the,
Well, you put an order in, an exit order, and then walk away. So it's a one
Yeah.
cancels other bracket trade.
yeah.
So it just says, um,
Yeah, and only Heinz could allow you to get in before that crossover, right? I mean, that's,
no, you can't get in before because you have to have the trade valid and then get in the next day.
yeah, got it.
So, but yeah,
Alright.
this setup happens like here. We got the crossover
Oh.
on this day, and your entry is here. But then as soon as you enter, the market drops.
Mhm.
These are the best trades. You can't ask for a better situation than these. End up being the best trades because you're getting in almost right away better than you can get in here. It's better than expected. You get in the next day better than expected. Get in the next day better than the next day, 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 the next day. You have all this time to get into this trade, and it would give you a bigger target than you originally planned on. So here your target would have been $1.65. That's the ATR. Here, it could be $1.65 plus a dollar, could be $2.65, it could be $3.65, it could be $4.65. So all of a sudden, because you didn't get in on day one, you instead of having a $1.65 target, you get in later in the day or the next day, now your target can be $2.65 or $3.65, taking your profits from 10 to 20% up to that 40, 50, 60% return at just the first target. So that's where patience or just life gives you a better opportunity than. So yeah, on the other trade, you might have missed it because you weren't there right at the open.
Mhm.
But on this one, by not being there right at the open, you actually end up with a much better profit than if you were there at the open on the other one. So these are the best trades. This is more what my trades look like. I tend to get in, okay, I never get into the open, doesn't happen because I'm not awake. But I'll get in somewhere after a pullback, and then see a takeoff. And because the win percentage doesn't change because it pulled back, it just means I can get it at a better price than expected.
Got it. Thank you.
All right, and yes, Becky will maintain all these stats. I'm going to show you a quick shot of that, what it looks like. Just so you know, these are not the stats for this particular strategy, but they're representative of the other 5 strategies. Our daily chart strategy is a series of 6 strategies. Let's see. Second, share ETF stats. Screen, do I have that here? Yeah, here it is. Okay, so again here, the sectors. Here is an example of one of the other strategies we trade for long and short. It is not the strategy you're seeing here today, but it'll give you a good feeling for one of the strategies. This was the long side of one of the strategies. This is for 1 expiration cycle worth of time. This is for 2 expiration cycles worth of time. If it's in light blue, it means it's 84% wins or higher. And you can see there's a lot more winning trades when you give it more time. Okay. This is data we maintain going back to 1999 for some ETFs and from 2005 for others. So anything you see here is based upon up to 20-something years worth of history. Some ETFs have only been around since 2005. This represents entire history. Some of them have been around way before that. And we have the stats that go back to 1999. So this is numbers you see here go back that far. This is the entire history of the ETF. So if we got like a buy signal on EFA, which is Australian markets, We know we're definitely not going to do one expiration cycle worth of time. We're going to be doing 2 expiration cycles worth of time to give us our high enough win-loss percentage, which is 84% minimum. If we get UNG, natural gas, buy signal, we're not going to do 1 expiration cycle, we're going to do 2. That gives us a high enough percentage. If we get XLV, healthcare, with this particular strategy, we might pass on this particular trade for this strategy because it doesn't give us the win-loss percentage which we want. So we use this to filter out which ones to take and which to not take in order to maintain our high win-loss percentages. And that's how we do all of our trade, whether it's ETFs or futures, we maintain a certain win-loss percentage. And that's how we know we're going to make money. This is a short side of that same strategy, but a short side. This is another one of our strategies for the long side, 1 expiration cycle and 2. So you can see the numbers of win-loss. And Becky updates this almost every month, but we send out a new copy every 3 months, quarterly. We send an update to the trading plan with all the trading plan has all the details of every strategy. It has all the settings for the indicators. So if you want to recreate this stuff manually on your own, you can. Otherwise, we will provide you all the indicators, all the settings ready to go. Whether it's NinjaTrader or Thinkorswim, we just hand it to you, it's ready to go. Let's get analyzing and trading. And this is our #1 favorite strategy for buying market bottoms, other than market internals. This is for buying market bottoms. So when the market pulls back, this is usually our very first buy signal. This is the one we've been trading the longest, longer than any other strategy. This Ichimoku strategy, we've been trading this longer than anything else, but it's perfect for buying market bottoms. Finding market bottoms and market tops is not that hard, just that the people who know how to do it don't want to show it to you. I believe in teaching you how to do it yourself, so you know how to do it. You don't have to rely on other people showing you this stuff. That's my belief. I will teach you how to do it so that you don't have to just rely on trade signals. And no, you will learn how to do it yourself. And when I coach people, I don't lecture like this. This is a one-sided thing. With coaching sessions, I guide you. I make you have to work. I make you have to think. I make you have to second guess some things, make mistakes, correct it, make some calculations. But I make you have to put in some effort, make you do homework, get back to me, and then we'll correct it because I want to see how you think, because trading is something we do on our own, usually. So I need to know you know what you're doing when you're by yourself to make this work for you. So when I do coaching sessions, I push you and I nudge you. It's okay, what's next? What do you see or don't see? Tell me what you're seeing or seeing. So I'll make sure you understand what's going on. But it's not a lecture. All right. And this was an ETF sell for finding market tops. And this is one of our favorite strategies for market tops also. And might be adding one more strategy for the long side. Stay tuned for that for the people who've seen this before. On the website, I'm going to change the share. All right, I usually here is the homepage, my website, behindscenes.com. And we are doing a special for the new year. This is $250 off the daily chart options program. It's also detailed in the handout, and $1,000 off the full program. Normally, I do $100 during the meetup. I do $100 off the daily charts program and $500 off the full options program. What we did for Black Friday and for the first part of this year is enhance that, but just for this first couple of weeks. So it's $250 off the daily chart program. That's like the strategy we went over today, and $1,000 off the full program. That includes daily chart strategies, weekly chart strategies, and the market internals. So I'll go through that a little bit about me here. What trading has been really able to do for me is let me leave my full-time job. I left in about 2009-ish. left Lockheed Martin, where I was a software engineer at Lockheed, but there's so much other stuff I wanted to do, and they kept telling me, well, when I retire in 30-something years, I'll have time to do all that stuff. And I said, what? I gotta wait 30-something years to have a life and do things? No. I like to work on films. I work on stunts. I do train in jiu-jitsu. I'm part of city government. I've been spent the last 10 years as a commissioner in the city of Santa Clara. I'm a martial artist. I like to go to concerts, music. 2 weeks ago, I got set on fire. That's right, I got set on fire. We did burn training at stunt school. So they let us, I was literally set on fire. So they taught us how to get set on fire, what to do, and all the steps to set other people on fire. And we went through all those steps. It's kind of cool, so to speak, to get set on fire and understand how fire moves and when things are burning around you and how to put stuff out. And so it was really interesting and how to adapt. And so we learned a lot about how fire works, especially when it's on you. So that's the cool stuff that you can do when you have free time to not have to be in a cubicle working for someone else 40 hours a week. So instead of having one 40-hour-a-week job, I now have 10 different things I do for maybe 40 to 60 hours a week. But not everything pays money, but it gives me more fulfillment. So I can make money trading. I teach fitness class, I teach kickboxing, I teach jiu-jitsu. That's income. I go do an acting job on a commercial or film, stunts, and so different streams of income coming different ways. But when things shut down in 2020 for COVID, guess what? Literally my only income was trading. Trading got better than ever. So trading is a consistent no matter what. Doesn't matter what's happening in the world. If there's terror and fear and everything, yay for us, because we can capitalize on that and still be making money up or down. If everything's going great, yay, great for us, because we can make money going up or down. So and I said 2020 was my most profitable year trading. So I was so focused. I had nothing else to do. So, and a little bit more about me is on this podcast. I got interviewed. I didn't know what to expect. They just told me they're going to ask me whatever one they want to ask me. And I just went in cold and they just asked me and I just answered. So everything was without a thought. So feel free to check this podcast out. A couple of links to videos on the site here also, one of our futures videos. And for fun, a while back, someone told me they only want to trade a NASDAQ. I'm like, we have 20-something ETFs. If you only trade the NASDAQ, the Qs, you won't have very many trades. And they were like, that's all I want to trade, just one thing. And so I was like, so it made me kind of interested. So I decided to put all the trades onto one chart, and this is what it looked like. But in 2020, I was 40-something trades with 3 losses. And when I laid this out, I was like, this is interesting. But when you put it on a picture like this, you realize, wow. And this is becoming a specialist on just a certain thing. So, and it came up again more recently, trading the Dow, Nasdaq, S&P only. So the last couple of meetups, we just focused on the Dow, Nasdaq, S&P, and I showed only trading those, and just trading those alone was like, wow. It's the same strategies, but just focusing on just the Dow, Nasdaq, and S&P only, becoming specialist. You see profit just amplified. That's trading a whole program that gives you everything available to trade. It just gets amplified big time. All right, and so I'm going to switch back to the handout. Yeah. This is why it's fun for me. I love trading and doing technical analysis. This is my thing. All my engineering skills have come into play with the analysis because I know how to analyze things and I just get all into it. Plus, it's different when I'm doing analysis for me and for Becky as opposed to for the mega corporation, because we benefit from our work. The harder we work, the more time we put into it, it works for us. So if you're interested in working with me on options, it's 1750 minus 250. It's normally minus 100 on the meetups, but for that special, it's going to be minus 250. So it's $1,500. I do everything one-on-one. I don't believe in doing group trainings. Everyone's different. Everyone learns differently. So there's certain people something I think might be simple, and I'll say it and they're just not getting it. And I might have to find 3 or 4 different ways of saying the exact same thing to get someone to understand it. That's why I like doing stuff one-on-one, to make sure people understand the concept and what I'm talking about, because once you get it, you get it. Because you can literally review 28 ETFs and 6 strategies in 5 to 6 minutes. That's all it takes every day. Once you get into and I can show you how to do that. And once I show you how to do that, you're like, wow, it's like bam, bam, bam. You can tell what to spend time on or not to spend time on. But that's all it takes. You can be really efficient the way I do it, the way I think through it, and the way I show you how to do it. But I said, and I try to do a monthly review of your trades with you to try to find out what you might be doing right or wrong. You might be thinking you're doing everything right. I'll look at what you're doing, and we're just getting lucky. Okay. Or you might have losses, and your losses shouldn't be losses. If you have a loss, that's okay. But it has to be a good loss, meaning if it was a valid loss per plan, great. If it's a loss that should not have been a loss, we need to take a closer look at that. Because something's wrong. You should not have an extra loss here. It was like, what happened? And sometimes people think they're doing everything right. They truly, truly believe they're doing everything right. And when I look at it, I look at them, it's like, take a look at this. They're like, wow, we got lucky, or we've been messing up and blaming you for the losses. Still, that happens also. That's why I want to make sure you're actually doing it right. Your thought process is correct, because it's something you have to do on your own for the long term. Okay. And the full program, we include the weekly charts, daily charts, and market internals. Market internals is more market sentiment combined with technicals. It's a completely different approach to trading, but it works really well, and we get bigger returns because we get the buy signals for the market internals even before the other chart strategies. So market internals is a special thing that gives us early buy signals. So if you want to, and for this one, it's going to be $1,000 off this price, $29.95. If you're doing this one, give it several months to really implement everything. It's a lot of stuff to work on and become familiar with. Like I said, I send out emails every night. It helps a lot, but it still takes time. Don't rush yourself. We have a long ways to go. Trades come every day, every week, every month. There's no big rush. And a daily chart, take $250 off of that. We could probably do this for more hours. When we did in-person meetups, we would go literally like 2 to 3 hours, or sometimes longer, just hanging out in person and working on this stuff. Sometimes at least 3 hours sometimes. But let's go ahead and wrap this up for today. We always go quite a bit long, and we get into that time where we needed to end the meeting. We're going to be having another meetup in 2 weeks on the 21st. It's going to be on futures, and I'm going to focusing heavily on currency futures. Is really where the money's at, and that's been working for us forever, going back to 2007 or 8. Currencies have been our thing, okay, and it still is. If you have any questions, now's a good time, or email me, message me. Okay.
Yeah, Eversley.
Hey, Gordon.
Hi. Yeah, well, right now I just had a question, and right now many of the market index ETFs, like the SPY, the QQQ, and DIAs, the diamonds, they've surpassed their 12-month highs and the 3-month highs.
Yep.
And right now they're pulling back, and it kind of makes sense in context of what you said earlier, that last week of December and the early week of January, seasonally they pull back.
Yep.
And my question is, do you believe the market is overall bullish and the market will continue to go past their 12-month highs and three-year highs? Or so that's my question.
1 second. Okay, I'm going to change the share. I just look at the charts and do nothing beyond the charts. I'm going to share this here on the S&P. This is years of the S&P. The Dow and Nasdaq look exactly the same. Massive, massive uptrend. This is 2011, 2012, 2013, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, now 24. This is the market. Massive uptrend. And we're going to get it, and eventually we're going to get this pullback, and it's going to scare people, right? They're going to say, what are they going to say? The market's dropped 10%. We're in a bear market now. That's literally what they're going to say, right?
Maybe, yeah.
That's what they're going to say. And yeah, it's good. 10% is nothing. We know the market pulls back anywhere from 20 something, 30 to 60%, and it's nothing, because we're going to retrace this if we do our standard Fibonacci type stuff. No, this is a monthly chart, keep that in mind too. But we're going to have a retrace of this. This is going to pull back. It's going to pull back at least 50%, at least, from this past swing. That's just normal. That's just normal enough and expected. If that goes from, and that right there alone is 10%. And they're going to say, oh, it pulled back 10%. We're in a bear market now. The market's going to keep falling forever and ever and ever. Okay. But that's literally what every network just sort of says, because they got nothing else to say. Someone writes their copy for them and they automatically tell them, oh, bear market. It's going to go up, it's going to pull back. It's going to go up, it's going to pull back. Eventually it's going to pull back all the way to support. It's going to be freaking people out. Big picture. That's why I like big picture. Massive uptrend.
So what is that? It's ES on that's not the spiders though, is it?
S&P. Doesn't matter whether ES or SPY, it's the same chart. This is futures.
Right, that's why I was like, yeah, that's a futures chart. Just for grins, could you bring up the spiders?
It would be the exact same thing. It's just a different way of trading it.
Oh, you're almost there.
It's the exact same. Yeah, the S&P futures and S&P is, like I said, it's the exact same thing. It's a different way of trading it.
So basically, you think that it could drop as much as 50%, but it'll just be like a pullback.
50% of this swing.
Of the swing.
Of this swing. This is a monthly chart. But that's normal. We have a double top here. We know there's gonna be sell signals here. This is normal. The previous high is gonna pull back, and it's gonna pull back, and this is gonna be moving higher, and it's gonna pull back, and they're gonna meet up eventually. So we're gonna get some bearish moves somewhere along the way this year. There's gonna be still trending higher, and they're gonna meet somewhere along the way and bounce higher. Just the same thing that's been happening year after year after year. So every time we're above the 40, it pulls back, it pulls back, it pulls back, it pulls back, pulls back, and it'll pull back again. Yeah, no market flow. Just don't freak out. Like when, like those, that's why having those weekly seasonal charts that like on Seasonal Trader. If you take a look at this last year, the market did everything it's supposed to do and expected to do. There's nothing out of the ordinary. It's normal market movements. That's why I like the seasonal charts, because I can take a look at those and see, oh, yeah, seasonally the market's bearish to sideways in this time, and yep, that's exactly what the market's doing.
So right now we should just expect it that overall the market will be bullish and create new highs, but expect to have a pullback that'll go maybe 50 or to the 61
of this swing.
Of this swing. Oh, okay, right.
Of this swing. So yeah, it would be normal to see a pullback, and this can happen. Remember, these are monthly charts. This can chop sideways for a while. Summertime is sideways and down for summertime. So we have a long, people who are claiming doom and gloom. Doom and gloom might be down here. That's a whole different deal. You got to have something to trigger doom and gloom. And that's for investors, not for us. If you're an investor and you have a 401k, well, it's going to suck. But for us, it's like cha-ching. We just capitalize on it. That's the benefit of being a trader and not an investor. Investor, you wait for it to pull back, buy, wait for the pullback, buy. Next time major investing in might be sometime later this year. Remember, is when it pulls back again, somewhere down here, buy. But the uptrend has been in place since 2009. Hasn't changed except for more than a few weeks at a time. Maybe 3 weeks. In 2020, it pulled back for what, 3 weeks? And then took off back into the trend.
Well, that was very circumstantial because of COVID.
Yeah. And but that's just normal stuff. There's always something to trigger it, but pull back. But that's why I don't care about news. Couldn't care less. Nothing in this chart says COVID, right? Nothing here says COVID. It's just a pullback.
Right.
Yeah, nothing says anything. Is who cares what? Why? You already know that I don't care why. You already know that. It's just I'm a pure technical trader, and that's it. I look at the charts. Remember, COVID isn't the only thing going on in the world. All right, that's one thing. There are many other things going on in all different around the world driving markets. There are wars going on. There's this going on. Everything's going on. There's things driving in the price of oil and gas. Everything's going on. But news will focus on one thing. There is not just one thing happening. Just what the news is focusing on that particular week or that day. Everyone talks about. Then the next week they'll talk about something else. Then everyone will blame that. Then next week they'll blame someone else or something else. But who cares? That's why pure technicals. That's why it works for me. When I was starting out trading, we'd look at all the reasons why, and we'd hear all these smart people talk. And I finally realized it's like those smart people don't know anything. It's like they can tell us a nice concept. Okay, when do we buy? When do we sell? They can't tell you that because they're investors. They're not traders. This is trading. So my energy is on trading, not big picture talk. I like to have an entry price, a target price, exit price, how to manage the risk, and that's all stuff we go over, as you already know. All right, let's go ahead and end this, and we will start this up again in 2 weeks. When we do futures on the 21st, and if you're interested in working with me on options, call me, message me. I'm going to have this discount going up until this coming Friday, and then that will cease to exist for the $1,000 off on the full package and the $250 off on this one. And we'll get you going on it. If you already have some option knowledge, perfect. If not, I will hold your hands as needed. I will help you with everything, set up your platform, set up your account, whatever you need help with. That's why it's one-on-one, whether it's on Zoom or in person. All right. And I'll be in touch with you guys with the next meetup in a couple of weeks, and see you all later.